All right, welcome. I know many of you guys have been waiting here to go live. Some of you guys are watching the recording later on, but either way, welcome. Grateful to have you here. As quick thing, because it does take some time for you guys to jump in. Go ahead and just say, "Hey, I'm from wherever, like wherever in the country or the world you are." Go ahead and just type that in the chat for those of you that are live right now. Love to be able to interact with you, know who I'm talking to, because naturally I can't see you, even though you can see me. So it's like you're a peeping tom, and I'm grateful to have you on either way. So I'm excited today because we are going to talk about what is this holy grail, right? Like, what is this holy grail we can actually use with savings that can give us everything that we want? Hey, Christopher, glad to have you on from Nebraska. Awesome to see you here too. So good. All right. Well, without further ado, I'm just going to jump right in because I want to see if I can make this as quick as possible. Maybe even open up for a few questions. We got another person from Nebraska too. And we got Bakersfield, California. So glad to have you guys. Hey, just so you're aware, because it does take time for me to see this, just be aware that any questions that pop up, feel free to ask them during this presentation. I will come back around and answer your questions. If there's any gaps or holes that I miss, just go ahead and ask away. And then I'll just go back through and answer those. So, all right. So let me just dig right in. Okay. There we go. Perfect. All right, so this Holy Grail strategy, right? Now, for those of you guys that followed me for a while, this may seem like something I've talked about before, but I'm going to take a different angle with it that you may not have heard before either. And so I always like to add new things. I always want to make this fresh and different because I've realized that for me, repetition is good, but at the same time, sometimes you have to just hear it in a different way to be able to get this whole other perspective of how you can utilize something. Because as there was a monk that once said, he said, "I don't fear the man that's practiced 10,000 punches once. I fear the man that's practiced one punch 10,000 times." And so I want to really dig into this. It's like, what is the strategy? How can you actually get better bang for your buck while making your money safer, get a higher ROI, but safer than even what you can do at the bank? That's what I'm going to talk about today. So again, like I just mentioned, we're going to talk about that, how you can use to get one of these set up, because it's not something that anybody can do. And so only certain people can do this. And so you want to see if you can actually qualify for it. And of course, it's a great way to keep your cash liquid, but you can also invest at the same time. In fact, I'll even show you how you can actually invest it in two places at once. Now, understand this is kind of like the Swiss Army knife of savings. I don't know if you guys ever had a Swiss Army knife before. I had one when I was a kid, and I thought it was the coolest thing ever. I mean, half of the things I didn't even know how to use, but I thought it was cool, right? Because you just pull these different things out of it, and so many little different tools. And that's the thing is like, the more you understand the tools and how you can use it, the more valuable it becomes. And so that's part of what I'm talking about today is just what are the multiple uses you can do. This is not just money to sit around and do nothing, even though it can do that. There's actually ways to actively use this, again, to make money in more places than just one. And so I want to talk about different ways that not only have I used it and our clients, but also how throughout history, many guys have used it as well, and even currently using it, especially the wealthy. Now, imagine this. What if you had like the perfect savings account? And I was trying to imagine, like, what would be the perfect savings account for me, right? Well, one, obviously, it's got to be liquid. I got to be able to touch it, right? I got to be able to use it for whatever I want, whenever I want. It can't just be like a CD where it's locked up and then they're going to penalize me if I try to touch it, right? That's not exactly like a good liquid savings. I know there's savings accounts in the bank or money markets that I could do that with too, but I want to make sure it is liquid. I can get to it. Also, even though I can get to it, no one else can get to it. This is something you can't do with bank savings accounts, because bank savings accounts, even IRAs, those things can be tapped into. If you get sued, for example, you get lawsuits or creditors come after you, they can get to it. So I want the savings account that actually is not only something I can get to whenever I want, but nobody else can get to it when they want. Also, of course, we talked about this before, high returns. How can we actually have returns that beat inflation? So even when it sits there, I don't feel like my money's not doing anything. Secondly, wouldn't it be cool if it's tax-free? Because I always envy the Canadians up north, our friends up there where they got tax-free savings accounts. We don't get that benefit here in the US, right? So what if it were tax-free as well? But also, what if it were safe from bank failures? Because we've seen that every time we've gone to bad recessions, there's always bank failures. Well, I don't want my money at risk, and I don't trust FDIC because FDIC doesn't have enough money on hand to do that. And of course, even cooler, what if not only is it tax-free, it's protected, I can get to it whenever I want, and it's giving me high returns. But on top of that, even when I die, it can go to my family, but it grows. It gets bigger when it goes to my family, and it goes to them still tax-free. How many guys would think that would be like a freaking awesome savings account? And if you want to just type quickly, just type Y for yes and for no, right? But wouldn't that be a freaking awesome savings account? I agree, right? And so this is the shift. This is what the wealthy have done differently. The wealthy don't just use simple little savings accounts, right? And they're not even just using brokerage accounts, even though they can use those too. It's something much better. And here's the deal: it's that your cash should not be, it should actually be an asset, not a liability to you. You shouldn't have cash just sitting around that you feel like it's just earning nothing in the bank, right? That you are losing to inflation, right? That it's just sitting there not making money. And you're thinking that now there's this opportunity cost. So you could be doing something better with it. But at the same time, you need to have the safety and the flexibility too. But again, you're losing inflation. You're losing by not making money on that money, right? And so what if we could have all those things we've always wanted? And here's the thing, Buffett, he is doing the same thing right now. In fact, cash is so important. And you should believe cash is important too. Right now, Warren Buffett's got almost 30% of his money sitting in cash, the most money he's ever had on hand. Again, this is the guy heralded as the greatest quote unquote investor. And what's he doing? He's investing less. He has more sitting in cash. But again, when they say he puts it in cash or cash equivalents, it doesn't mean he's just having money sitting around making no money. There's a strategy to it, and he wants it liquid and available because he wants to make sure that money's ready to go when we need it. Because here's the deal, guys. I know many of you guys already believe this, and if you don't know it for certain, you probably feel this: is that there's something big, possibly bad, coming on the horizon. We've had so many great years. The stock market's gone straight up pretty much for 16 years in a row, almost, except for one down year, and then that we've almost forgotten about that now. We've got the fact that real estate has just kept skyrocketing up, and people become less and less, things become less and less affordable. It's becoming harder and harder even to save money. And when people's cash starts getting tighter and tighter, this is usually when we move right into a recession. When things go on sale, they go cheap. And as a result, most people can't buy them. But if you're smart, you have the cash on hand ready to go when everything's on sale. Just like Buffett. That's what Buffett's doing right now. You could be in that same position. So Buffett's doing the same thing. By the way, Buffett's already been selling off his Bank of America stock, and he also sold off Apple, where most people are telling you to buy Apple. Buffett already sold it. The smart investors already sold most of the things that people are telling you right now to go buy in the stock market. This is not the time to be buying in the stock market, as Buffett's already doing. By the way, everybody always thinks Buffett's some old crazy old guy, but every time we go into a recession, people say, "Oh, oops, I was the idiot," right? Buffett was smart. He knew it was coming. I didn't. I lost money. Buffett doesn't lose money like that. Buffett keeps growing his wealth into the freaking hundreds of billions of dollars, while everybody else is hoping and praying they have hundreds of thousands of dollars. That's the difference. What is a Swiss Army knife? Whole life insurance. Yep, the boring old freaking life insurance. Now, don't get scared just because I said whole life insurance, right? Because this is not the traditional whole life. This is not the stuff that Dave Ramsey poo-poos all over, because I agree with him. There are some really bad pieces of crap. Now, if you don't even know what whole life insurance is, right? Most people know about term life insurance, where that's just a death benefit, right? You have to die for somebody else to get paid. That's term life insurance. The guy that's one of the co-authors of some of the Rich Dad Poor Dad books, if you ever know Tom Wheelwright, he's the CPA. He talks about that term life insurance is an expense, but whole life insurance is an asset. And the reason is this: is that term life insurance is just death insurance. Whole life insurance, yes, it has a death benefit for that benefit, but it also has this tax-free savings account inside of it that is protected from lawsuits, creditors. It is tax-free. It's currently paying about 6% a year. And of course, it's actually giving people the opportunity to make more money with it and invest with it too. So we're not talking about the traditional whole life that's just expensive rip-off stuff, right? But here's the difference. Traditional savings, you got stagnant savings that don't really make anything. It's point nothing percent. There's no protection on that money. It can literally be garnished. It can be, money can be pulled right out of your account, whether you like it or not. There's a lower ROI, as I mentioned, right? Like it could be, even if you get high yield savings account right now, like my high yield savings account with Capital One, even though it's one of the highest out there, it's paying like 3.5, 3.6%. That's it. And then of course I get taxed on that 3.5 or 3.6%. And there's less leverage. I don't have the ability to really do much with it. I mean, I do have a little bit at least, which is good from a cash reserve standpoint if I'm trying to get loans, but I don't have quite the leverage I get over here. And of course, less opportunity to grow that money. Because again, if I pull that money out of savings, then I don't make money in savings. I then invest it, right? So at least I can invest with it. But again, I can't make money in two places at once like I can with infinite banking, where I have 6% plus growth. that is tax-free. It's protected 100% from lawsuits of creditors in most states. It is a place I can actually maximize my ROI, and get great bank leverage, and even do some cool things better, which you can sometimes do with savings accounts. So we'll talk about that in a little bit. And it got huge opportunity for growing that money in two places at once. Now, don't have to take my word for it. We got guys, right? Like, I mean, obviously we have Nelson Nash who talked about the book, Be Your Own Banker, that kind of thing. Ferdinand, how does it make 6%? I'll get to actually how it does create 6% dividends. There are some that pay more, some are paying a little bit less, but most companies we're using are paying at least 6% right now of actual tax-free dividends. But yes, remind me of that question, because I would talk about the details, how that really works and where they make their money. This is different. This is max ROI infinite banking, right? This is a much different type of thing. Now, guys have used it before, like guys like Walt Disney, J.C. Penney. You probably heard of them. Walt Disney, just to give you an example, he didn't have the cash to start Disneyland. He had some cash, but the banks didn't want to give him a loan for it. They didn't think the idea would work. There was this new up and coming network called ABC that said, yeah, we'll give you some of the money, but Walt, you need to pony up some of your own money too. You need to give us some collateral. So he sold an investment, his second home, he sold his vacation home, and he put his life insurance, not the death benefit, but the tax-free savings account, as collateral, so that ABC came in with the rest of the money, and the rest is history. Now we got this multi-billion, if not trillion-dollar corporation as a result. J.C. Penney, actually during the Great Depression, was paying his employees using his life insurance policies. And it's not just the guys in the black and white photos, right? We got even guys nowadays doing it. You ever know this coach, Jim Harbaugh? Used to be with the University of Michigan. Now he's actually with the San Diego Chargers in the NFL. But in 2016, he negotiated in his contract when he was getting his compensation. He said, hey, listen, instead of just paying me all of my salary, right, just paying it normal, which your salary gets taxed, here's a cool thing he did. And by the way, this might be new for even those of you that have seen me present on this many times. Here's what he did. He's actually had Michigan loan him $4 million up front plus $2 million a year that went to fund into his life insurance policy. So he set up his own life insurance policy in his name. He even put some of his own money in, but then he allowed them to put some money in as well. Almost like when you put in a 401k and you want to get that company match, right? He had them do it here. He didn't have them do 401ks because rich people don't use 401ks. That's what they give broke people, because they lead you to believe the 401k is the best thing in the world, and it's a piece of crap. Okay. Even Roth IRAs aren't that great, even though that's better than even the 401k. But he actually set it up with a policy. They would contribute in. So they would loan him money. Now think about it. Why would they loan him money to go into his policy, to fund his policy? Well, this loan, for one, was a 0% loan, but they did it as a loan because how much do you pay on taxes on loans? Big fat goose egg, right? So they still want to be paid back this money. But what they did is they loaned him this cash to then put into his policy, which of course is growing, guaranteed, making money, and it's earning nice not double digit returns, but he's earning nice returns, like 5-6% even at that time. Actually back then, 2016, they're actually paying over 6% back then because interest rates are a little bit higher overall. So anyways, he was having them put that money in, 0% loan, going into that policy, leveraging that money to grow his cash inside of there. And then, of course, he had access to be able to use that wherever he wanted to. The only thing is he had to make sure he had at least kept enough cash in there to pay them back. So he was just trying to earn interest off their money, kind of like what the government does off of us, right? Whenever you overpay your taxes, you're overpaying the government, aren't you? And when you overpay them, all that money you overpay in your paychecks and everything, and then you're so happy you get that tax return back after the next year. You know what that is? That's just a 0% loan that you gave the US government. You gave it to the IRS to have them use that money, make money off of it, or pay for their things, right? And then they pay it back to you after a year. They basically have this 0% loan on you. Jim Harbaugh is just doing the same thing. He was having them pay him money. They said, yes, you have to leave at least enough cash in there to pay us back at some point if you decide to ever leave us at Michigan, which eventually he did. And of course, by the way, this also bought more death benefits. So he's actually increasing a death benefit to increase more tax-free benefit to his heirs. And he's able to make interest off of their money interest-free, right? So he's creating a spread on that money too. So he's creating a leverage. He's able to make more money off of it. He literally has been doing this with every place he's going. And now I don't have the San Diego Chargers. Like I haven't seen in the contract what it is or been able to find it, but that's exactly what he had Michigan do. And man, it works. So yes, there are ways to do it. I love what Bear Bryant says, another sports coach, right? He says that offense sells tickets, but defense wins championships. Guys, what if you can actually have a good offense and have a good defense at the same time in one place? That's what we're talking about here. Now, again, like I said, this is not the traditional type of infinite banking type of thing, right? For example, when I first heard about this, I used to be a financial advisor. For those that didn't know this, in the early 2000s, I was a financial advisor. I taught everybody to set it and forget it, save it forever, spend nothing, save everything, put it into mutual funds, and eventually you're going to have millions of dollars, right? Because you're going to make 12% in the market. That's what I used to teach. Now, after 4 years of doing that, I realized that people weren't becoming financially free because the market wasn't paying 10, 12%. It wasn't even paying 10%. You're looking to get 8 or 9% in the stock market, even in the S&P 500. And most of the time people have mutual funds that do even worse than that. And so I was telling them all these things that I thought were true, and it really wasn't. And that's why people were retiring broke. Well, I started looking for answers, and I found all these real estate investors. And then what do these real estate investors start talking about besides real estate? They start talking about this infinite banking concept, right? That Nelson Nash guy had created. And so in 2006, I got the book, how to be, becoming your own banker. I read it. I said, okay, looks kind of cool, but it's whole life insurance. As a financial advisor, I was taught whole life was the worst thing you could possibly buy. But all these guys kept saying like, no, man, it's the best thing ever. Now, here's the thing. Like I went to the same guy they all referred to, right? They said, this guy's the guy. So I went to him. I went to buy my policy, and I remember looking at it. Now, remember, I had an insurance license. So I wasn't an idiot when it came to life insurance. I knew how life insurance worked. Now, whole life insurance, I didn't know about because I was always taught as a financial advisor that to never, ever offer whole life insurance. I was told it was boring. You only make like 2% a year. You don't make any money in them. Don't use them. And so I would sell people that were more stock market based things. So I'd still sell them life insurance, but it'd be more stock insurance type stuff. And then of course, what do I see? I see this whole life thing. And when I started to see the numbers, I said, man, this is kind of expensive. And I told the guy, I said, listen, I know with other types of insurance like universal life, I can adjust things to make it cheaper. Can I do that with this policy? And he said, no. If you try to adjust the numbers, or you try to pay more in than what you have, you'll trigger taxes. I said, well, I hate taxes, so let's not do that. So I bought the policy. This is 2006. What happens by 2008, right? We have all the real estate markets going nuts in a bad way, right? It's tanking. My real estate was tanking, even though I was able to retire when I was 28 years old in 2006. Still, all the real estate was starting to tank. I had started a new business with a guy named Garrett Gunderson, and as we started that new business, that business was almost bankrupt, and we were going in the hole each month, and I was not even taking paychecks for several of those months. And so as a result, I was in a place where I couldn't afford to keep paying this $1,000 a month premium. I had paid 25 grand of this policy. And when I went to talk to the insurance company saying, hey, can I stop paying? They said, no, if you do, you lose it. And so because my cash flow was so restricted, I had to lose it. 25,000 went in and I lost it all, right? It was like the biggest waste. It was like the most expensive term insurance policy I could have bought. Even though it was factored his whole life. Yeah, I was covered for a couple of years to protect my family, but I spent $1,000 a month, $25,000 to only lose it all. Months later, I'm starting to look into this deeper. I was talking to a friend of mine, and we started to research this more and found out that I could have actually pulled some levers to make it better. And so I had a nice little debate argument with the insurance agent that sold this to me. And we're going back and forth about what's better, and, should we do it like this or like that? Can we pull levers to make it richer? And finally, at the end of it, the insurance agent just said, like, listen, Chris, I did it this way because I couldn't afford to cut my commissions. I said, there's the truth. And I said, and by the way, I'm not sending you any more of my friends or family or clients again, because I'd sent him dozens of people to talk to him about life insurance, only to find out he was ripping all of us off. And so this is why, as a result, I was looking for something better. And really over the last 18 years, I've been working on this to make it better and better and better, to the point where now we found a way to make it more like this max ROI infinite banking, not the typical, even traditional infinite banking or traditional whole life. It's different, right? Much different. Here's what it looks like. This is an example that looks like what mine kind of looked like in some ways, but not. In fact, and it might be a little bit small for you to see, depending if you're watching on your phone or on your screen here, but I'll kind of help break it down. The one on the left, this is the vanilla whole life. I had an insurance agent. He came to me. He says, hey, I know you're independently broker with different companies. This is one of them I know you work with. Can it be done better? And so this neurosurgeon, this 35-year-old woman, had bought this policy, putting in 60,000 a year, $5,000 a month. She's put into this policy. Now, if you can see it, you'll see there highlighted in yellow on this left-hand side, you can see that the first couple of years she's paying in 60,000 a year, it's zero cash is in this policy. That means all of it is going to pay for the insurance costs. This is what my policy looked like. Even though I was putting in 12,000 a year, all of it was going to insurance costs. It wasn't until the third year I finally had some money. Same thing with hers. She put in, now by 3 years, she's put in $180,000, 60,000 times 3 years. 180,000, she has 30,000 bucks. You know, that is why people like Dave Ramsey say that whole life insurance is a ripoff, because it's true. If you set it up like this, it is a ripoff compared to the right-hand side, which is what we do. And I said, and I showed this to him. I said, here's what I could do with the same health rating that she got and with the same exact company, but pulling all these different levers to give the max ROI possible on this. By the way, it also cuts our commissions down by like 80%, right? This is how we did it. And so first year, you see it's not a zero. First year, she has $50,000. Even by year 3, she's got almost as much money as she's put into it. Not 30,000, but like 160 plus $1,000 in it. That means we've saved her like over 135,000 plus in costs that now go into her cash tax-free savings account that she can access at any time. Even that first year, that 50,000, she can access at any time. That money is available. This is what happened to me in the recession. If I had access to cash, if I wouldn't have had it all going to insurance costs, I could have just stopped paying my premiums and it would have self-funded. It would have kept going. I would never lost my coverage for my family. And eventually, as I dug back out, I would have had another cash savings account I can get access and get into. So that's the difference. Just so you know, there's always going to be costs coming out, especially in those first couple of years. Life insurance, whole life insurance specifically, is front loaded. It's expensive up front, but gets cheaper over time. Term life insurance is cheap up front, but then gets more expensive as you get older. Same thing with universal life insurance. If people always ask about that, because they're like, isn't that infinite banking? No, it's not. That one actually gets more expensive over time and can actually rip you off later in life, not just earlier. And there's even times that all the times that we see them all the time anyways, people send us numbers, we still beat them with the whole life that has all the certainty behind it. So anyways, long story short, here's what it actually looked like, right? Because if you want to see those numbers, here's what it is. The traditional plan, there's no cash until year 3. And even then it was only 30,000 bucks. And it took you until year 13 to break even. That means she had to pay $60,000 a year for 13 years before she finally had as much in cash as what she had paid out of pocket. She finally got to 0% net return. The difference is on mine, like I said, one at year 3 had 168,000. Ours, you had more cash than you paid into it by year 5. So where normally it takes at least 13 to 17 years to finally break even, we're doing it by year 5. Despite the insurance costs coming out, it's already net gain profit by year 3, and it keeps growing and going to the point where it actually beats the savings account between years 5 and 10. So you actually make more money in the savings account and you protect your family. So you have the insurance. You don't have to buy term invest the difference. It literally, you can do better just doing this way than that other way. Oh, and here's the cool thing. Even by year 25, because some people say, oh, well, up front you had more money, but maybe down the road, that other one would have more money. No, it had 2.38 million after 25 years, where ours had over 3 million in cash. That freaking saves you like almost $700,000 of costs right there. That means you have 700,000 more. And that's not even the best example ever, right? I actually had this couple, and you can scan this QR code to watch it after this class, right? But this couple, Jay and Krista, they were on my podcast talking about this. And they actually wanted me, they actually had infinite banking policies, and not like the crappy one I said. It was actually in between what ours is and that crappy example. So it was kind of in between, which is what most infinite bankers do. So if you've ever even had an infinite banking policy, they had it for 6 or 7 years. They've been paying these policies. They even got past the expensive first years to where it's starting to pay for itself. And they said, hey, Chris, can you analyze it to make sure that at least the numbers we have are okay? And I said, yeah, I mean, you're probably okay at this point because you've paid your dues with those first couple years or so. But sure, I'll do an apples-to-apples comparison. Guys, I did an apples-to-apples comparison. You know what it was? We actually made a $2.25 million difference in 20 years. Them paying the same amount of money. They're paying about $150,000 between the two policies, between him and his wife. $150,000 a year they're paying into these policies. And with mine, despite even having to start over again with those upfront costs, still after 20 years, you had $2.25 million more money in that tax-free savings account. That's a huge return. What could you do with $2.25 million more in 20 years? That's literally money you could be actually, and even in this case, you could live off of it tax-free, you could probably generate roughly about, let's see, 8% of that, roughly about 150,000 a year you could pull off of that for decades, tax-free, just from that extra amount of money, not even what they already had in there too. So that's exactly what they've been paying into it. They get to get 150,000 more of income. So that was a massive deal. Oh, and yes, and they still had a higher death benefit too. So here's the key thing. If you want to learn what's the difference here, don't let your money be stolen by agents that have high fees and costs. You should get the max ROI every time, not the agent, right? And again, that's what we do, right? That's where we minimize those costs as low as you can possibly go while keeping it tax-free. This is a question I know will always come up, so I'll address it right now. Someone will say, well, hey, can you front load this? Can you dump a ton of cash up front and then just lower those costs even more than normal? And the answer is yes, you can, but you lose the tax-free status and you lose the protection of your money. So if somebody does sue you or you have creditors that are coming after you, they can now get to that money. It loses this protective barrier. So you got to be careful. So you do get taxed, you lose the tax-free status too. So yes, can you do it? Yes, but it may not be worth what you're giving up. Now, like I said, this isn't for everybody, right? One, if you are living paycheck to paycheck, if you're literally, you have not two nickels rubbed together because you have no money to even put away into any kind of savings, this is not for you. You would be better off just buying a term insurance right now. Ideally, though, if you buy term insurance, and that's something we offer too, you can actually buy a convertible term insurance policy. So even if anything happens to your health in the meantime, while you get that, maybe you start to make more money, find the cash frees up, you can convert that term to a whole life policy to get all the same benefits. And they don't ask any questions about your health. So you can literally convert it and be able to get that max ROI policy, even if you're uninsurable. Because that's the other thing. The other type of person that's not for as well is somebody who's in bad health. I had somebody who I don't know exactly what happened in her health history because they HIPAA laws kind of keep that hidden from us. But something happened from the year that we got her policy, the term policy, to the next year where she was uninsurable. But luckily, even though she had that top highest health rating before, and the insurance company knew about that she was uninsurable, they still had to honor her converting to that permanent policy from that term policy. So even if you're paycheck to paycheck, just know you can set up a term life policy to actually convert to one of these policies later on when the cash flow is better. By the way, I recommend that you fund at least $5,000 a year. If you can do that, if you can save at least $5,000 a year, this can be for you. Also, if you're, like I said, in bad health, doesn't work for you, right? If you're bad health, if you're well into your 70s or 80s, this may not be the strategy that we use, at least not like for the investment purposes. There might be some insurance we can still get, but it might be a little bit different looking. But even if you're in bad health, I had a client who was in very bad health in his mid 50s. And he said, Chris, even if I get qualified for this, it's going to be expensive. He said, but what about my wife? Could we set up a policy on her? I said, well, is she healthy? He's like, oh yeah, she's great health. She even runs races and stuff. She's 52 years old. I'm like, oh, cool. So she's younger, she's healthier. And guess what? She's also a woman. Women live longer. So even if you're the same age and same health rating, guess what? Women get the better rate of return than men. And I said, this is actually could be a perfect scenario for you because yeah, we could get a policy on her instead of you, get a much higher ROI, return on your investment here. And so we did. He's been putting away $110,000 a year into her name, into her policy. He controls it. He can fund it and do all that kind of stuff. But here's what's cool. Cool or not cool. He did actually have a situation where he was sued. And guess where's the one place they cannot garnish his money? They can garnish wages. They can take everything and drain his savings accounts, his IRAs, and all of his retirement accounts. The one place they can't touch is right here. He literally has hundreds of thousands of dollars. And despite that lawsuit, they cannot touch that money. Now, they could try to ask him to do it, but they can't legally get to it. They can't put a garnish or any kind of a lien on his life insurance. They can put a lien on his house, but they cannot put on his life insurance. Isn't that cool? So anyways, not the fact that he got sued, that wasn't cool, but the fact that his money was protected, just like we talked about and promised, that was cool. So here's the thing, guys. You can compound your money 6% a year, tax-free, protected from lawsuits and creditors, and it's guaranteed to grow. Just so you know that even though it's paying around 6% a year right now, the guarantee is usually about 3% or so, depending on the company. Some are 4%, some are 2%, but most companies we use are 3% plus on the guaranteed side. Now, I will go back to Ferdinand's question, right? He's like, how does it make 6%? I'm actually going to address that now. How does it make 6%? A few different ways. If you look for an insurance company, the best type of insurance companies to look for are mutual insurance companies. Not all the time, but usually mutual insurance companies are the best companies to go for. You've probably heard of companies like Northwestern Mutual, Mass Mutual, New York Life. Doesn't say mutual, but they're a mutual company, right? Penn Mutual, right? I mean, all these kind of mutual type companies are companies that they're mutuals because they don't have stock shareholders. Understand that companies like MetLife, they trade on the stock market. All those extra profits get paid to the stock shareholders. But in a mutual company, they're kind of like a credit union where they pay back to the members, right? Not to shareholders. And so, like credit union, they pay usually a little bit higher interest rates. Same here. They'll pay you a little bit more from being a mutual company. I select mutual companies that have been paying their dividends above their guarantee for at least 100 years straight, consecutively. That means they've been paying since pre Great Depression. The cool thing is, some of the companies we use, two of them are my two favorite. They've actually been paying every single year above their minimum guarantee since pre-Civil War, since like before like the 1850s or 1840s. One of them's been since 1847. It's almost gone on 180 years straight paying. Banks can't claim that. In the Great Depression, did you know that about 60% of banks failed? There was 35,000 banks in 1929. By the end of the Great Depression, but going into 1935, there was only 13,000 left. So nearly 2/3 went out of business. Insurance companies, it was like less than 20 went out of business. Why? Because unlike banks can't over leverage. They can't lend out more money than what they have. You ever notice that bank can lend out more times than what they have in cash? Insurance companies don't do that. They can't do that legally. And they're also backed up by reinsurance companies. So that's where the guarantee comes from. Now, Ferdinand, to answer that question, I'm gonna put that up there again. How does it make 6%? This is how in mutual companies, they pay you three ways. One, because of that return of premium. See, I always laugh when you get guys like Dave Ramsey say they're just returning your money back to you. Yeah. Why? Because when you get a rebate or a refund, they don't tax it. So one of the ways to help it be tax free is they refund the money back. That's the guarantee. So they always really what's the word? They budget in. They always budget in that say it's a guarantee of 3%. They always budget in that 3% going back to you every year. In fact, they'll even pay it to you monthly. They'll split it up over a monthly basis, right? But then the extra above and beyond that, the extra dividend is also it's the IRS code 7702, right? Which is the tax-free status. It's kind of like Roth IRA status for life insurance. That money actually, also goes in and pays once per year. That extra money comes from one, the return on their portfolio because they have an investment portfolio, mostly invest in things like treasuries. So right now, what do they keep talking about? They keep saying that inflation's still sticky. The feds may not lower the rates much more, if at all, depending on what inflation does, right? And as those rates stay higher, your dividends go up. A lot of these companies were paying 6% or less just a year or two ago because the interest rates went rock bottom in 2020. Now they're starting to pay to 6% plus because the interest rates went up. So because of inflation, if you worry about inflation, this one actually does try to keep pace overall because as a response to inflation, Feds usually increase their interest rates. That helps you. You make more money. And yeah, they'll invest in things like private equity with a small piece of their portfolio, real estate and things like that. But for the most part, it's like treasuries and things that are very safe. They also make, if it's a mutual company, as I mentioned before, all the profits they get paid back to you as the shareholder. Here's the interesting thing to consider. Did you know that in almost every insurance company I've worked with over the last almost quarter century now, right? It makes you sound old, quarter century. That's 25 years, right? But almost every insurance company I've talked to, they love term life insurance because the normal consumer, the average American likes cheap, right? We like Walmart, Costco prices, don't we? Well, it's cheap, so it's easy to market. And two, less than 1% of all term policies ever pay out. Less than 1%. That's their big money maker. That's their big profit maker. The whole life, not so much, right? They'll make a little bit, but not nearly as much as they make on the term life. Why do you think it's the insurance companies that started the whole strategy of buy term and invest the difference? And then they tell you the strategy. Once you have enough assets in your 60s and 70s, when you're likely to die, then you cancel your life insurance. Who do you think taught that? Who started that? It wasn't financial geniuses. It wasn't the wealthy. They don't believe that crap. It was the insurance companies that taught it to the average American who is be ignorant to the fact that they make all their money, their profits off that. And guess where those profits in mutual companies get paid to? You, when you own the whole life policy. Just checking in because I know I'm just ranting a little bit and I'm kind of went off script a little bit. Is anybody getting anything out of this? Are you learning something now or picking something up? Because this is important to understand that insurance companies don't want you to understand how to manipulate the system this way. And don't worry, most people won't anyways. But the wealth, they've been doing this for years, for decades, or even centuries. This has been around. So hopefully you're getting something out of this. All right. Good. I'm glad you guys are getting some good stuff out of this. That's awesome. All right. So now we're going to move into, comparing this to like high yield savings account. It already does better. It's protected from lawsuits, creditors. As I mentioned, they don't have, the fees are differing or whatever else, but there's a lot of different stuff, but definitely low risk, higher returns, less government control. Ooh, that's the other thing too. If government changes the rules, even the tax rules on life insurance, because it's a contract, you get the tax rules of today. Know that we've actually had the tax-free status on this for over 100 years on life insurance. They talk about getting rid of that tax-free status, but the reason they don't is because guess what the politicians also have? You got it. They got the whole life insurance, right? They don't want to lose their tax-free status either. So that's what they use. Because most politicians, just so you know, can't even qualify for typical 401ks. You make too much money to do that. So again, this is one of their loopholes. They already create the loopholes for them to be able to save their own money into these type of things. But if you ever have a 401k, for example, 401ks, they can change the rules whenever they want. If they decide that 59.5 rule is too young, they can bump up to 62.5. What if you're 58 years old and you're like, crap, now I got to wait 4 more years? Thanks, government. You have no say in the matter, right? So again, you have way more leverage and freedom to do stuff here. But here, I want to get into this now. Here are the ways you can use it. And then I'm going to try to shut up because I already went longer than I was planning on going today. One, you can use it as collateral, just like Walt Disney did. He used it as collateral. You can do the same thing. I had one client who actually used it as collateral. In fact, he was talking about canceling his policy because he had $300,000 sitting in his tax-free savings account. He said, you know what? Maybe I'm just going to cancel this policy, take cash out, and just get a very tiny mortgage, because he needed to do some build out and stuff. He's like, maybe I'll just pay all cash for this building as much as I can. I said, slow down there, Sparky. Before you just go on and do that, let's talk to your bank. Let's see if not just the building can be collateral, but what if you can use that cash as collateral too? So he talked to his bank. It was actually a credit union. He went to talk to him. He said, hey, instead of just doing a normal mortgage, what if I offer this as extra collateral? They said, we would love that. In fact, we'll even lower your interest rate by 2.5% on his mortgage rate. So he went from supposed to have like a 6.5% mortgage down to like a freaking 2.75% mortgage. Actually, no, sorry, 3.75%. He went from like 6.5 down to 3.75%. His payment, and he also got extra money for a build out. It's like extra $75,000 for the build out. So he was able to have more money to be able to do that. And the payment was like a little like $1,800 a month. In a year and a half, he not only built it out, he started renting out the other spaces in that building. He was officing in that building too, but he was able to be there rent free, essentially, right? Because he had the other renters paying for his rent. He went back to the bank just a year and a half later and said, listen, we've built it out. We've got renters in it. I think the value is there. Can we take the lien off my life insurance now? And they said, yes, but we're going to keep the interest rate the same. We're going to leave you with the same, like 3.75 dirt cheap interest rate on a building. Just so you know, 3.75% on a building, on a commercial building is like almost unheard of. Especially because interest rates are very similar now like they were then when he got that loan. So just so you know, that's incredible. So that's one way he was able to use that as collateral. And again, got the lien off it. Now he can use it for whatever he wants for something else. Emergency fund and business reserves. This is what I use it for a lot. I actually realized that, and pay attention, because this is how I use it myself. I realized that I was like, wait a minute, the banks right now are paying me 0.nothing%. It was a nice little run we had when the rates went up and then they came crashing right back down. And now my bank pays me nothing again. And even my high yield savings account is not quite as high yield as it was when it was like around 5%. Now it's like 3.5. Well, what if I could get my money in a better place, making more money, and I don't have to pay taxes on it? In fact, even better, I don't have to report any interest to the IRS like I have to do with every little bank account that I have. I said, this is awesome. So I started moving all my reserves, other than a little bit that I need to get to overnight, I moved it over to my life insurance. So out of my 400,000 cash reserve that I have for just our family, 300,000 is in the life insurance. The other 100,000 is split between high yield savings and the bank. Because again, I want to get to it. It does take about a week or so for me to get the money from my life insurance for it to transfer over. So that's the only thing. It might now if I do it through a bank, I can sometimes do it in a couple day transfer, just like if you transfer your high yield savings account to your bank. But still, because I want to plan for like a week plus if I want to get to it. That's for the bigger emergencies. I keep the bigger share there. Do the math. Like my credit union right now is paying me 0.05% on my money. If I had 400,000 sitting in the bank at 0.05%, I make $200 a year that I then have to pay taxes on that $200 a year. But by having 300,000 earning 6% tax free, now I'm making 18 grand on that cash. And I've also now got 100,000 that's making me, like a whopping $50 a year or whatever that I pay taxes on. So I've just now made way, way more money. Like I don't even know how many times more, a lot more times, like not quite 100 times, but a lot more, right? And I'm able to make because I did that move. So that's big. And I have people all the time like, yeah, I've got my business emergency reserves. Where do I keep that? Hey, this is an option. You can keep extra money in there for business reserves too, that if you had to get to it, you could get to it. Big deal. If you learn nothing else from this, that alone would say this as a savings account would be like the ideal situation. This becomes a Swiss Army knife. But guess what? There's a little corkscrew thing you can use too that pops out your Swiss Army knife. That's like your kids' savings. People are starting to hate their 529 college savings plans. One, because the returns in the market aren't great and usually underperform the market. And two, what happens if all of a sudden the market tanks right before your kid goes to college? Anybody who had their kid going to college in 2022 know what I'm talking about, because when the market tanked, you saw your 529 plan tank with it. Even if you had 4 years of savings saved up, you went down to 3 years. And you're like, oh crap, now I have to like fund the money out of pocket again, right? Plus, what if your kid doesn't go to college? What if they end up, which by the way, right now we're seeing more and more kids choosing not to go to college. Enrollments are down now. We've also seen the fact that what if you get a full ride scholarship or even get a scholarship or Pell Grants or whatever it might be where you don't need it anymore? Well, that's why more people are turning to this. This also, another reason why people turn to this, if they're talking about for getting college funding, if they do go to college if at all, is this does not count as an asset for your college funding. So yes, it counts as an asset. Like when that guy tried to get a mortgage, it counts as an asset when you want it to count. But when you don't want it to count as an asset, like when you're getting sued or when you're trying to get college financing or any kind of Pell Grants or scholarships, funds, things like that, this does not count as an asset. You can have millions of dollars stored here and they won't count as an asset for your college savings. That's pretty freaking awesome, huh? So anyways, people are doing more and more this way and they can be more flexible with it. And again, if they don't go to college, no big deal. They don't get penalized for trying to touch it. They didn't go to college. You can use it for other things. We have a guy on our team right now that literally his dad set up for him. By the way, his dad had owned a stock trading company that he sold to TD Ameritrade. He's also been an entrepreneur and had businesses in all different sorts and forms. He even says this is his favorite quote unquote investment, even though it's a savings, it's not an investment. This is his favorite one. It's the one he always counts on, the one he never worries about, never loses sleep over. And when he set up for his son, who now works for us, he set up as a college savings account, but his son said, no, I'm just going to get cheap student loans at like 3%. So he got all the student loans to finance college for 3%. And then even after he left college, he said, no, I'm still not going to use the funds to pay off college because it's 3%, right? And you're writing it off anyways. So instead, what did he do? He used that money to end up helping him start a business and start making money that way and creating wealth instead of trying to pay off debt only. So again, Swiss Army knife, right? You got all these little things you can use. I already mentioned extra retirement income. You can literally pull off tax-free retirement income and you do not have, let me say that again. You do not donut. It's not a donut. Donut. Anyways, you do not have to save, wait till you're 59 and a half. You can literally retire in your 30s using this. I have one client that literally set up his plan to do it that way. Fund it for 10 years and then use that as an income stream with his real estate properties to then do that, which leads to my next one, cash flowing investments. You can use it for real estate. You can use it for, you could invest in the stock market. You can blow it in Vegas. You can use it for whatever you want. You don't have to tell them the reason. It doesn't matter. But here's the cool thing. I want to show you how this works. And this is what I'm going to kind of end on a little bit. How do you make this work where you earn money in two places at once? I promised I was going to talk about this. Most people just take money from their savings, they drain it, and they invest it. Pretty simple, right? It really does. It seems to do that. You drain your checking, your savings account, and you go in and fund the investment. Well, after you've drained your savings account, how much money is being earned in interest in your savings account now? Nothing, right? Because you just drained it. But what if you could have your savings account still have the money in there and still have the money to invest at the same time? So you're earning money here and there. What if you could do that? That's what we're talking about right here. That's what you can do. So instead of using your bank savings account, what if you instead ran your savings through here? By the way, we have so many more people stop funding their 401ks when they realize, wait, I could retire early. I could actually create cash flowing investments right now using this because now I can go and use this money to make money in two places at once. Now, how does that work? It works this way. Now, if you withdraw the money, there's two ways you can access the money inside your life insurance. You can withdraw the money, like you would have a savings account, or you borrow. Now, you might ask, why would I borrow my own money? Well, the answer is you're not borrowing your own money. You're borrowing the insurance company's money or the banks if they're giving you a line of credit against it. So withdrawal, if you do withdraw money from your life insurance, yes, you lose the ability to earn interest inside the life insurance, right? You're not making those tax-free returns anymore. So what most people will pick, including myself, is I will go and loan from the insurance company. They'll put the insurance, the cash, that savings account as collateral. And they'll usually give you a line of credit up to 95%. So if you have $100,000 sitting in here, they'll let you access 95,000, right? So they'll give you a line of credit. Here's the cool thing about the line of credit. You could pay it back however, whenever you want. The deadline for paying it back is your death. So unlike credit cards or home equity lines of credit, which are very similar, right? If you're trying to get a line of credit that way, the difference is you have to make monthly payments back to it. This is harder for people that are especially trying to invest in things that maybe take time to pay back, whether it be investing in your business, investing in like maybe you're trying to do a fix and flip on a rental property or whatever it might be. You know, it takes time to sometimes get those returns and you're having to come out of pocket when you use a credit card or a line of credit. Here, yes, they'll charge you interest, but you have no minimum monthly payment. You can pay it back however, whenever you want. If you don't pay it back at all, great. They just take out your death benefit. They take whatever you owe them, and then they pay the rest of your family tax-free. So for example, say that you borrowed $500,000, but you have a $2 million death benefit when you die. Well, they'll take their $500,000 back to pay off their loan, and then they'll pay the $1.5 million to your family tax-free, right? So that's one of the cool things you can do. So yes, they do charge you interest. You do not quote unquote pay yourself interest like some of those infinite bankers will lie about. That's not the fact. But the reality is better because here's what's actually happening. When you're getting a loan from the bank or from the insurance company, either one, you get a loan from them, they are charging you interest. But remember, your money's still in there. Your money's still in there compounding and growing tax-free interest. So you didn't touch your money. So it's still there earning tax-free while you have interest paying to them. But if you use it for cash flowing investments, like I mentioned, whether it's in your business, your real estate, or whatever investing you're trying to do, and you take the cash flow or the returns from that investment to go back to pay back towards that line of credit, what happens is that you create this spread. You start paying simple interest, which gets lower and lower as time goes on, while they're paying you compounding interest that compounds as time goes on. You've seen compounding interest because say, for example, you have that 100 grand, 6%, you now have $106,000. But the next year, you're in 6%, 106,000. Now you have 112,000 and change. The year after that, you have 118,000 and change. Then the year after that, you have like 125,000 and it compounds. But the loan that you're paying on is simple interest, which means the interest goes less and less as time goes on. You create a little spread, a little delta, as some people call it, right? You're creating a spread where you're earning more in interest than you're paying them. So you make money in the policy and you're still making money in the cash flowing investments that you're putting the money into. You're literally making money in two places at once. If you even make just a 1% overall return on your money while making, say, 10% over here, you now just made 11% total versus just your 10% you would have made just using your checking or savings account. That's the difference. Even people who do it for marketing strategies, great way to do it. You funnel it back through, pick up extra dollars. You could pick up hundreds of dollars of extra interest along the way doing it that way as well. Here's an example using an actual fourplex. Now, I use this with my own policy, right? So what would be the difference between using just cash out of a savings account paying 0.1% versus me using my actual life insurance policy that has insurance costs coming out, has interest factored in? What's my net gain? What's the difference? Well, if you have a $250,000 down payment on a $1 million property and say your cash flow is $2,500 a month. Now, if you just liquidate your savings account, that $2,500 a month comes back into your savings account and starts to build it back up slowly again while you earn little pennies on that interest. With the life insurance, you borrow that $250,000. Your $250 is still in there, plus whatever cash is in there, growing tax-free. Use that $250, and then you're paying back the line of credit, right? Because again, you're borrowing from the insurance company, not from yourself. You're paying back the line of credit with that. What's the difference? On the savings account, earning 0.1% after you pay taxes, I would make $1,200 of interest after 9 years in that $2,500 a month scenario going in. That's out of $270,000 that gets paid in over 9 years. I make $1,200 in interest. Not exciting, is it? What about the life insurance? Even after the insurance costs, even after the interest costs that I'm paying to the insurance company that doesn't get paid to me, but paid to them, even after you take all that out, what's the net gain that I got? 126,000. Guys, that's 100 times more in just 9 years. And again, this is not theory. This is literally with my policy, right? It's like I'm in my mid 40s now, definitely late 40s, but I ran these numbers in my mid 40s. That's the difference. Again, it could be better or worse depending on your situation. But even if it was a little bit worse, even if you said, "Hey, I only got half that. I only got 63,000." Well, that's sure better than 1,200 bucks, isn't it? So what would you rather have? 126 or 1,200 bucks? 126,000 or 1,200 bucks, right? Kind of a no-brainer, isn't it? That's how you make money in two places at once. So when you hear that about infinite banking, that's how it actually works. And the great thing is you can pay down the loan and reinvest again and again, because as you pay back that line of credit, guess what? Frees up the cash that you can use it again. Just like if you were to pay back a home equity line of credit, you're like, cool, now I have money I can use again to reinvest and do it over and over and over. Is that what you always should do? Not necessarily. Right now, I'm doing more of that Buffett strategy where I'm building up more cash. I'm using all of my own cash first out of checking and savings before I ever go to my life insurance, because I know my life insurance is going to make more money anyways. I make 6% versus point nothing percent or whatever I make in my bank, right? So that's where I will actually drain my bank checking and savings before I ever go to my life insurance for investment. So that's way to fund. That's kind of what I'm going to right here. First few years, I actually recommend you use your emergency fund to fund it. Diversified emergency fund, you kind of move it over. Just like when people move their money from a bank to a high yield savings account to transfer over to earn more interest, same thing. You can do the same exact thing, but do it for those first few years where there's a net cost. That makes sense. Don't use your investment money. Like some people are like, should I take all my investment money and put in here? No, I wouldn't. As an investor, I wouldn't do that, even though there are people that would do that. There are people that will say that. But no, what I'll do is instead I'll say use your emergency fund to go over here. So you start to move that over while you invest all your cash right now, year one. So say, for example, you have $300,000 and say that you want to, save 25,000 a year into your policy. Well, cool. 300,000, like say that I'm only going to invest 200,000 anyways, because I want to keep 100,000 of cash reserves. Well, I'll invest that 200,000, making me say 10% a year. That's 20,000 a year. Well, the cool thing is now I'm making 20,000 a year on that 200,000. I can reinvest that, make a little bit more. So for a few years, I can actually get up to about 25,000 a year before I even go to the money I was saving, which by the way, after year 3, your policy is now making more than what it cost you in insurance costs. So now it is like a literally like tax-free savings account with no net cost coming out. You could put that money in, pull it right back out and invest with it. And guess what? You're already making enough cash flow, passive income that you're actually able to pay for that 25,000 a year premium. And so it's actually like zero net out of pocket when you do it that way. That's how I prefer to set them up. There are insurance guys that would love for you to dump all your cash in so they make bigger commissions. Problem is they make more money, not you. And that gets right back to the same crap, right? Just to kind of let you know, like what are other real estate investors, how they use it. Ron, he uses it because he just knows the bank doesn't do anything. And he has that creditor protection. He can make more money off of it. And he knows that insurance companies don't go out of business like banks do. This other guy, Neil, same thing. He didn't want that bank exposure, that risk exposure to banks, and he wanted the creditor protection. We had this guy right here, which funny enough, yes, we've have you watching right now. He's actually on live right now watching this. He said his only regret was that he just didn't do it sooner, but he's now teaching his kids to do the same thing. Some people ask me, is 60 years old too old? No, I've had plenty of people in their 60s getting these policies, even to their late 60s. And so, no, you can definitely do it. But the younger you are, the better. These things never get cheaper for you, because the older you get, they always creep up in cost. So if you want the best ROI possible, start now. Notice I didn't even talk much about the death benefit. Generational wealth, if you want to be like the Rothschilds, Rockefellers, what do? They not just put policies on themselves, their spouses, they also put policies on all their kids that all paid into the estate. And then when the kids, instead of becoming trust fund babies to get all the cash out, because now you got all this tax-free money in your estate, instead what they do, they had to borrow from the estate to go start businesses, invest, and do different things, even go to college. They would have to pay it back into the estate. So then their estate doesn't shrink and just get consumed by their trust fund babies. No, instead, they do the same thing. And then, of course, they buy policies on themselves, put on their kids, they fund the family trust, and it just keeps growing their family's wealth over and over. That's how the Rothschilds and the Rockefellers did it. Unfortunately, guys like the Vanderbilts, they lost it, and now they have nothing. So again, just remember this. No one cares more about your cash or savings more than you do, nor should they. But that's why you need to be extra careful, because you should be able to make the most of your money that you have in reserves. So why not do that, right? So here's how you can do it. And actually, we got the link right here too. There it is. There's a little bit.ly link if you want to use that, a little bit shorter. If you are interested in seeing if this is the right strategy, I know, Ferdinand, you asked, is Money Ripples a broker? Where to go to find out more about services? Here you go. You can click there, book a call with our infinite banking specialist, and they'll be honest with you. I mean, if they say, listen, like this is not the right fit for you, maybe you should just do term insurance, they'll tell you. If they're saying, hey, you've already got a policy, you want me to review a policy? Great. By the way, if you have a current policy and you want to see if it's good, even if it's universal life, whole life, whatever it is, and you want to see if it's any good, you can ask for what's called an in-force illustration from the insurance company that you have that policy through. They'll send you those numbers that show what's the projections going to look like from here forward. You don't have to even go to the agent. You just call up the 1-800 numbers for those insurance companies, and they'll send it to you. We can literally look at it, run an apples-apples comparison, just like I did for our clients, Jay and Krista, where to my surprise, not only was it better, but it was $2.25 million better, right? After just 20 years. But there's some cases where it's not better. I had a client, one of my old, clients we've had for 9 years. I've been working with them, and they sent me some of the policies. I said, hey, some of these policies are okay. Some of these other ones are not. So maybe we replace these ones, but these other ones we leave alone. And by the way, that money that moves over from the policy can move over tax-free to a new policy. So you can roll it over. So anyways, that's the way that you can schedule a call right there and see what you can do. So if there's any last minute questions, I know I went way longer than I expected, but hopefully this was very valuable for you guys. Maybe if some of you guys learned something new, put in the chat here. What do you think about that? I see there's a question here that was asked about what about the interest? I'm guessing I probably answered that question, like what's the interest, like the interest rate? Like I said, like the interest rate, oh, that's the other thing. Loan rate right now depends on the company. Most of the time, they're usually right around where the dividend rate is. So like, for example, one company they're paying 6% right now, but their loan rate's 5.3. But they'll try to create a spread to where maybe it'll be like a 0.6% spread or something like that. Some companies don't have a spread, some companies do. It just depends. But again, that's why we look at different options, see what works. We are a broker in the sense that we work with different companies. So for example, someone in the state of New York, we might do a different policy for you than somebody in the state of New Jersey, right across the way, right? So again, it's always case by case, but typically, again, we always use companies that have been like very highly rated on the Comdex, usually over a score of 90 on the Comdex, and they've been paying for over 100 years straight. So again, if you want to have like a good kind of risk-free type of analysis, or even just to kind of see what those numbers look like, do that. But I definitely would suggest, like, if you're serious about getting your money out of banks where right now the interest rates are only getting worse, you want to go into something where the interest rates have been getting better and it's tax-free, protected from lawsuits to creditors, and have the ability to invest that money to create passive income now, which is the big thing I teach about how to become work optional today. Like we always talk about on moneyripples.com. Go check. This is something that you need to add to your arsenal. This is something that all the wealthy do. This is where people hold their cash, that they want us to have that safe money. I'll tell you, I have one client that actually, he said, I wish I had put more in my policies. He was 72 years old. He said, my only regret was I was trying to invest all my money. He was trying to buy a lot of real estate and do stuff. He's like, now my only regret is I don't have more safe cash, money that I know that is always going to be there no matter what. He's like, and I could even earn tax-free income off of it. So a lot of times people will use this to create wealth now, but it can also become a tax-free income down the road too. Even if you don't have to wait till you're 70 to do it. So, all right, guys. Well, I appreciate you being on. Again, if you guys are watching the recording, feel free to reach out to us. But guys, again, we're here to serve you. We want you to get the best. I don't want you to buy the crappy stuff like I bought. I want you to be able to do it the right way. You get the max ROI every single time. And that's our guarantee. You will not find anyone that does it better. You might find a rare less than 1% situation where somebody might match our numbers, but they'll never do it better. You want the best? Feel free to reach out to us. Thanks.